come to IAS 38 once again. Intangible asset. So we are right now going through the key terms used in the definition of intangible asset. We have seen two key terms: identifiability, control. The third important feature of intangible asset is that it should generate future economic benefit to the entity. Okay, there must be expected future economic benefit from the intangible asset to the entity. What do you mean by future economic benefit? The asset must be able to save cost. So if you have developed a technology, technical know-how, process, okay, system that may be saving cost for the entity, like you may have developed a software for accounting purpose, in-house accounting purpose, that will save your cost, okay, or the asset should help in generating revenue in future. Two ways you can generate revenue: either that intangible that you have created itself is sold, multiplied and sold again and again, or that intangible is used to produce something which may be sold, okay, to generate revenue in future. Or it can be a combination of the both. You can use it for saving the cost, at the same time you can use it for generation of revenue, then it is future economic benefit. Now research expenditure we don't capitalize. Why? Because in research expenditure it is difficult to prove or demonstrate that the research expenditure will generate future economic benefit. It is too early to say that research expenditure will generate future economic benefit. Hence, research expenditure is charged to profit and loss. Now some question answer. ASF Limited has an expertise in consulting business. In past 30 years, company has gained a market share for its services of 30% and considers recognizing it as an intangible asset. Is the action by the company justified? Why no? So first is, it does not have separate identifiability. You cannot sell it, exchange, okay, lease out. And second, it does not arises from any contractual or legal rights also. You can also add it, you do not have control also. Company does not have control. Can you check the loyalty of the customer? No. One more question printed towards the end of the chapter. A company XYZ has provided training to its staff on various new topics like GST, goods, service and tax. Goods and service tax. To ensure the compliance as per the required law, can the company recognize such cost of staff training as intangible asset? What is that question number? But just first you answer, then search. The answer is no, because training given to staff, control is missing. Company cannot be assured of future economic benefit from that staff. It cannot control the staff from leaving the organization and providing the benefit to someone else. And if the staff is smart like you, he can start his own consultancy only. Now we'll come to recognition criteria. Definition criteria must be met. Then recognition criteria must be met. The recognition criteria are two. First, cost of an intangible asset can be measured reliably. In this chapter, this is important. And many internally generated, I will write IGIA, internally generated intangible asset are not capitalized. For example, internally generated brand is not capitalized. Internally generated goodwill is not capitalized. The reason is that cost cannot be measured reliably, because we spend a lot of money on business development. So we really cannot differentiate between expenditure for normal business development and the amount that is spent on brand building. Since the cost cannot be measured reliably, the standard will tell you that you will not be able to capitalize such cost. And second thing we are repeating again, it is possible that expected future economic benefit attributable to the asset will flow to the entity. Whatever is that asset, the expected future benefit should be flowing to the entity. So this is your recognition principle. So now tell me, suppose I have to ask you, you are my article example only, and I am your senior boss, okay? What is the checklist for intangible asset? Before you bring an intangible asset into balance sheet, what are the things you are going to check? Is it identifiable? Is it non-monetary asset? Is it without physical substance? Control is with the enterprise? Future economic benefit will flow to the enterprise? And cost can be measured reliably. So this is like a checklist for intangible asset to be capitalized. If all the answers are positive, yes, welcome to the world of intangible asset. Okay. Otherwise, either it is not an intangible asset, it is some other asset, or it is to be charged to profit and loss account. What is the measurement principle? Day one accounting. Day one accounting is intangible asset will initially be measured at cost. Okay. Now what are the items to be included in cost and excluded? So in your diagram, included items are mentioned. Purchase price. Purchase price will include basic purchase price plus import duty plus non-refundable taxes minus rebate. Same like IAS 610. And directly attributable cost. That is those costs which are required to bring the intangible asset to the usable condition. Those costs which are required to bring the intangible asset to its usable condition. That is the condition in which the management intends to use it. Example, any employee benefit related cost can be added if it is directly attributable. Professional fees, legal fees, cost of testing also, okay, will be added. And what is excluded, read the note below, we'll discuss after a few minutes. Now first we will see cost of separately acquired intangible asset. That is those intangible where you pay cash or cash equivalent. Simple, okay. Now here we will add all cost incurred up to bringing the intangible asset to its usable condition. And then this table I have drawn for better understanding. You will add the basic purchase price. You will add duties and taxes. But if any duty and taxes are refundable, that need not be added. Okay, or to that extent need not be added. Like if you have paid GST, so if you can take that input credit while paying the duty on sale or final goods, then you need not add it. And then any directly attributable expenditure which makes the intangible asset ready for its intended use. And you will deduct trade discount and rebate. Okay. And now we are going to discuss those expenses which will not form part of cost of an intangible asset. Okay. For example, they have specifically given some example which you will keep in mind while solving a numerical question. They will give you 15 items. and out of 15 they will ask you finally what is the amount at which intangible asset will be measured initially. So which item we don't have to add? Cost of introducing a new product or service. Don't add. Example of cost of introducing a new product or service is advertisement and promotional expenses. Suppose you keep, say, let's say Alia Bhatt as brand ambassador for promoting an intangible software. Okay, buy FR pen drive. Not me. Alia Bhatt is saying, okay. And we are paying her 20 lakh rupees as brand endorsement fees. Charge to P&L account. Okay. That was just an example. Cost of conducting business in a new location or with a new class of customer. For example, cost of staff training. Charge to P&L account. So that means if you are shifting from one location to another, training your employee to deal with new type of customer. Okay, charge to P&L account. And administration and other general overheads. However, if you can demonstrate that these expenditure are directly attributable to bring the intangible asset to its desired intended use, then it can be capitalized. Now the question is, what about intangible asset acquired in exchange of another asset? So we'll discuss some other typical situations where we don't pay cash or cash equivalent, but we acquire intangible asset. Cost depends on the mode in which intangible asset is acquired. So one usual example is intangible asset acquired in exchange of another asset. Okay. So you have, suppose, a car given, and you acquired software. So intangible asset, software acquired against a car, or you can give some securities like investment, or you can issue securities. If you issue securities, then IFRS 2 will apply. Okay, share based payment. Or you can provide some service. You can say that you give me software, we'll provide you 10 days free hotel accommodation for all your staff. Okay, or you can arrange a conference in our hotel, give us the software. So what about the accounting treatment of this intangible asset acquired? That is the question. Like other standards, especially IAS 16, which has exactly the same paragraph, that intangible asset is acquired in exchange of another asset, the cost of such an asset is measured at fair value. Unless the transaction lacks commercial substance or the fair value of neither the asset received nor the asset given up is reliably measurable. Same paragraph in IAS 16 also. Now, when does a transaction has commercial substance or lacks commercial substance? An entity determines whether an exchange transaction has commercial substance by considering the extent to which the future cash flows are expected to change as a result of the transaction. Generally, if two asset exchange are exactly same, then it is not going to make any impact on exchange. So therefore, in that case, you will not take fair value. Then what will you do? You will take the book value of the asset given up. If the asset acquired is not measurable at fair value, in two situations it is not measured at fair value. When the transaction does not have commercial substance or fair value of both assets cannot be determined, then the cost is measured by carrying amount of the asset given up. Okay. Now, if suppose I can measure the fair value of both the item, then what I'll do? If the entity is able to measure reliably fair value of either the asset given up or asset received, then the fair value of the asset given up is used to measure the cost, unless the fair value of the asset received is more clearly evident. So they should have just written fair value of the asset given up or asset received, whichever is more clearly evident. Now, of course, this will involve some degree of subjectivity. Is it right? If both are clearly evident, then you have to toss which is more clearly evident. Two examples we'll discuss. First, a small simple example. X Limited purchased a patent, market value rupees 10 lakh from Y Limited in exchange of investment worth rupees 6 lakh on the transaction date. X Limited also paid rupees 2.5 lakh as balance consideration. At what amount X Limited should record the patents? So what we have exchanged? We have given investment worth 6 lakh plus 2.5 lakh. So consideration given is in cash and kind 8.5 lakh. Patent acquired, market value is 10 lakh. So should the patent be recorded at 10 lakh or 8.5 lakh? Whose fair value is more clearly evident? So if the investment fair value is more clearly evident, then 8.5 lakh. If the patent's fair value is more clearly evident, then rupees 10 lakh. Write down both the answers. Question is not clear. Now investment, you are saying investment fair value, but what if it is investment of an unlisted share? So that is why I said write two answers. Assuming fair value of investment is more clearly evident, assuming fair value of investment is more clearly evident, patent will be recorded at rupees 8.5 lakh. Patent will be recorded at rupees 8.5 lakh. In bracket write that is 6 plus 2.5. That is 6 plus 2.5. However, if patent is more clearly evident, if fair value of patent is more clearly evident, then patent will be recorded at rupees 10 lakh. Patent will be recorded at rupees 10 lakh. Now one important question appearing in your self practice check. Question number 20. Okay. Sun Limited acquired a software from Earth Limited. Sun from Earth. In exchange for a telecommunication license. So who is transferring what? Understand. Interesting question. Sun will give telecom license to Earth and Earth will give software to Sun. That means both parties are acquiring intangible asset. Okay. Earth is also acquiring intangible asset, telecom license, and Sun is acquiring an intangible asset, software. The telecom license is carried in the books of Sun Limited at book value of telecom license is 5 lakh. The software is carried in the book of Earth Limited at rupees 10,000 only, 10k. which is not the fair value. Advise journal entries. What the student will have to do? Pass journal entries in the following situations in the books of Sun Limited and Earth Limited. Oh, you will have to pass both and entry in both set of books. We'll discuss later, but first understand three situations they have brought before you. Fair value of this software is 5 lakh and fair value of the telecom license is 5 lakh. This is 520 and 5. Second, fair value of software is not measurable. However, similar telecom license is transacted by another company at 4,90,000. In this case, both parties will record at 4,90,000. At least the fair value of one of them is available. Here, fair value of both are available. And the next is neither fair value of software nor telecom license can be reliably measured. So in this case, both party will record at the book value of the asset given up. Is it right? So that time this 5 lakh and this 10,000 will become relevant in the answer in the third question. So how will you pass journal entries? One by one. In your book we will discuss. Okay. See the answer. First, case 1. Case 1, fair value of the software is 520 and fair value of telecom is 5 lakh. So the journal entry in the books of Sun Limited. Sun Limited is acquiring software debit. At what amount? 5 lakh 20. Its own value. It's worth 520. Okay. To telecom license, remove the book value 5 lakh. And the difference is profit 20. In the Earth Limited, Earth is acquiring telecom license, which is worth 5 lakh. So debit telecom license at 5 lakh, credit the book value of software which is 10k, and the difference is a huge profit, 4,90,000. Second one, both parties will capitalize the respective intangible asset at 4,90,000. So fair value of the software is not measurable, only telecom license fair value is measurable. Journal entry in the books of Sun, software account debit 4,90,000. Loss account debit 10. Why loss 10? Because book value is 5 lakh. 2. Telecom license book value 5 lakh. And second party will pass the entry telecom license account debit 490 to software 10 to profit 480. Third is very interesting. In third case, fair value both are not available. So book value of the asset given up. So Sun Limited will pass the entry software account debit 5 lakh to telecom license 5 lakh. And the other party telecom license account debit 10 to software 10. Is it right? Later on they can revalue it upward or downward in case if they get the recoverable amount. Is it right? But right now our discussion is initial measurement. So for initial measurement, this is how the cost of the asset will be determined. Okay, one more, or before that, we will come to one theory discussion. If an intangible asset is acquired through business combination, if an intangible asset is acquired through business combination, now which standard deals with business combination? IFRS 3. So you have learned in IFRS 3, or you will learn if you have not yet studied, that the assets and liabilities acquired are measured at fair value. Simple. So in case intangible asset is acquired, if you can measure their fair value, even if they are not appearing in the statement of financial position of the acquiree, then also you will measure it at fair value if you can. And if you can't keep a separate fair value of that intangible asset, then it becomes part of goodwill. Is it right? So remember that journal entry for acquisition of a entity we debit the net assets taken over at fair value. We credit the consideration given at fair value, and the difference is usually goodwill as a balancing figure. But first what you will do, wherever possible, all intangible asset which fulfills the definition of intangible asset and recognition criteria and whose fair value can be measured, you debit them as a separate intangible asset. Goodwill is your last thing that you will do. Okay, so fair value. One more line is mentioned. If the intangible asset is separable, because in order to measure it, capitalize it as an intangible asset, it should also be separable from goodwill. If an intangible asset is separable but only together with other intangible asset, then the fair value of those intangible assets shall be measured as a whole. So sometimes the intangible asset may be separable, but then it is but only together with other intangible asset. Like what example I'll give you. Suppose you have a software, but this software is given as license to some customer. So you have a customer relationship also associated with this software. So here two intangible assets will be valued together as one, or many company put brand and trademark as one. Okay, then they will be measured as a whole. So if possible separately, if not, then wherever, if they are related, you can add them, and if you can't, then it will become goodwill. Is it right? If you can't separately identify intangible asset, then balancing figure is the goodwill. Now to keep you busy, we'll solve some questions. Question number 19. Question number 19 is, on 31st March 20x1, Earth India Limited paid 50 lakh for 100% interest in Sun India Limited. At that date, Sun Limited's net asset had a fair value of 30 lakh. So this question is related to two chapters actually. IFRS 3 also and IAS 38 also. In addition, Sun Limited also held the following rights. Trademark named Grand valued at 1,80,000 using a discounted cash flow technique. That means the brand can be separately fair valued. Separately, if identified, you capitalize it as a separate intangible asset at fair value. Sole distribution right to an electronic product. Future cash flow from which are estimated to be 1,50,000 per annum for the next 6 years. Now this is also an intangible asset, but here the student will have to do the valuation. How will you do the valuation? 1,50,000 per annum into 6-year annuity factor, which is based on 10% is appropriate discount rate. To help you, they have given you factor also. What a nice institute. Calculate goodwill and other intangible asset arising on acquisition. So what is your consideration? 50 lakh. Net asset other than intangible 30 lakh. This intangible separately identified, valued also given 1,80,000, and this you just have to take on your calculator. 1,50,000 into 4.36 is equal to, very good. So out of 50 lakh, we'll apportion 30 lakh towards other net asset. Trademark 1,80,000 already done. Distribution right 6,54,000. If the institute gives you factor, preferably use it, because then your answer will match with the institute suggested answer also. and then the total is 38,34,000. So the remaining amount will be attributed to goodwill, 11,66,000. Understood? So this was one small example on business combination where you acquire the intangible assets. Now next is payment deferred beyond normal credit terms. Payment deferred beyond normal credit terms. What does that mean? It means that if suppose you pay on a deferred terms which is more than the normal credit terms, then that supplier will include some interest also. Like for example, normally the supplier gives you 1 month, 2 months or 3 months credit. But you say, no, I will pay you after 1 year some amount, after 2 years some amount. Then in that case, the supplier is going to charge you some interest. So calculate the present value of this amount payable and then this present value or what is called cash price will be the cost of the asset, and the difference between this cash price and the total installment paid will be interest, will be recognized over a period of time as expense unless it can be capitalized under IAS 23. Okay. Solve one question. Question number 3 below. Answer you have to solve. I will give you 30 seconds to try your luck. 30 seconds starts now. Anybody who is able to reach the answer? You have to use calculator. Without calculator you can't solve. A patent right was purchased for a total payment of 40 lakh as per the deferred credit terms as explained below. So how this 40 lakh will be paid? Understand, the normal deferred credit allowed by seller is a 20% down payment and balance in 3 equal annual installment. But the deferred credit term to the company is, now this line is important which I am writing now, is 25% down payment. How much is 25% of 40 lakh? 10 lakh. And balance 30 lakhs in 5 equal installments. So 5 installment into 6 lakh. The normal deferred credit allowed by the company does not include any interest, whereas in a special credit period it charges 6% interest per annum. So this you need to discount at 6% discount rate. Cost of intangible asset equal to. So what you do, you draw this format which I have done for you. Year 0 cash flow 10 lakh and year 1 to 5 cash flow 6 lakh. Okay. Now discounting factor at 6% for 5 years. Come on. 4.2123. 4.2123 multiply 6 lakh into 4.2123. So this is how much? 25 lakh. 41. Therefore patent should be capitalized at rupees 35 lakh 27,000. You have to take the total of these two numbers. Okay. One more we will try. This is in self practice. Venus India Private Limited. Search. Acquired a software for its internal use. Question 18. Costing rupees 10 lakh. Costing rupees 10 lakh. The amount payable for this software was rupees 6 lakh immediately. 6 lakh immediately. And 4 lakh in 1 year time. And 4 lakh in 1 year's time. Understood? So 6 lakh plus 4 lakh. So this 6 lakh is immediately, no discounting involved, but this 4 lakh you need to discount it. The other expenditure, purchase tax add, entry tax 10%, recoverable later from tax department, don't add. Legal fees add, consultancy add, cost of capital is 10%. Only one small calculation you'll have to do. This 4 lakh rupees you have to discount at 10%. Compute the cost of software on initial recognition. Any answer? 1276.36. I know it is printed. Calculated. Okay, first is immediate cash payment 6 lakh. Present value of deferred payment 4 lakh divided by 1.10. 363. 636. Purchase tax will add because it is not refundable. Entry tax will not add because it is refundable. Legal fees I will add. It is required to bring it to its present condition for use, and consultancy fees will add. Take total, it comes to 1276.36. So this way you will present the answer. If at all this is asked, chances are less. And then the institute will give you step marking for writing correct answer here. If total matches, you get maximum mark. Okay. If an intangible asset is acquired through government grant, to finish it in one line, apply IAS 20. That's it. IAS 20 gives you two options. You can record it at fair value, or you can record it at nominal value. In case if you record it at nominal value, then you will also add any other expenditure that is directly attributable to preparing the asset for its intended use. Okay. Example of government grant relating to intangible asset. Airport landing right, license to operate radio or television station, import license, quota, rights to access other restricted resources like mining rights, okay, telecom rights, which are very valuable, spectrum. Solve one example. Due to contribution by ASF Limited to the society, the government has given a product license at a nominal consideration of rupees 40 lakh. The market value is rupees 3 crore. Company incurred 4 lakh on registration of the license. X Limited values license at nominal value. So what is their accounting policy? Nominal value. At what amount the license should be recorded? 4 lakh, 44 lakh, 3 crore, 3 crore 4 lakh. Choose the right option. Write down 44 lakh, 40 lakh towards license and 4 lakh towards registration. So the answer, write down 44 lakh. Answer won't appear on the screen. Right there, 4 lakh plus 40 lakh equal to 44 lakh. Explain in your own words in the exam. Now one more example is there. Example 5 in your question book. Just below that. On 1/4/2016, X Limited acquired a mining rights from the government at rupees 10 crore. The fair value is 100 crore. How should the entity account for mining at initial recognition? It has been estimated that the mineral would extracted over a period of 30 years and X Limited decided to amortize the mining right over 30 years on a straight line basis. X Limited should account intangible asset question mark in, and there is a accounting policy they have mentioned. X Limited values mining rights at fair value. So in this example, what is the amount at which they are going to recognize? 100 crore. And how much they had to pay to the government? 10 crore. So what about the difference? The difference will be treated as government grant, and that will be amortized over 30 years and on a straight line basis. Okay. So write down, if it is not written, I think it is written. Journal entry on initial recognition, written in your notes. Mining rights account debit 100 CR. Government deferred government grant 90 crore, balancing figure, and to bank account rupees 10 crore. Okay. Next question is internally generated goodwill. One simple line appearing, shall not be recognized as an asset. Internally generated goodwill and similar intangible assets, not just goodwill, it can be a brand also, are usually or not capitalized, not usually or not capitalized. Then the question is why? So the standard itself has given the reason. The standard says internally generated goodwill is not recognized as an asset because it is not an identifiable resource. That is, it is not separable, nor does it arise from contractual or other legal rights controlled by the entity that can be measured reliably at cost. It's not identifiable. Only goodwill cannot be separated from the business. Goodwill is always attached to the business. If only goodwill can be sold, then I will do that business only. Sell my goodwill. Okay. No need to come to class every day, spend so much time in making notes, making presentation, and shouting so much on the student. And the other reason is that its cost cannot be measured reliably. It develops over a period of time along with development of business. So we don't really know how much money has gone into goodwill calculation or goodwill creation. Now next question for you. ASF Limited's net worth is rupees 400 crore. The market capitalization is 560 crore. What is the difference between these two numbers? This is the book value of net assets. This is the balance sheet value of net asset, and this is the market value of the shares. So 160 is the difference, means market gives me 160 crore more than the book value of the net asset. Can this difference of 160 crore be treated as goodwill? No. Then the answer is not written. So the answer, write down 1 or 2 lines, I'll dictate. Write down, the difference cannot be termed as goodwill. The difference cannot be termed as goodwill. The difference between, then I am writing an explanation for that. The difference between the market capitalization, that is the market value of shares, and net worth, that is in bracket book value of net assets, is due to a large number of factors, which cannot be solely attributed to goodwill. is due to a large number of factors which cannot be solely means only attributed to goodwill, which cannot be solely attributed to goodwill. Okay. The market price of the share is affected by many factors. Okay. Prime Minister is elected, according to your choice, share price go up. Where is the goodwill of the company responsible for that? Or some land building, they may have followed cost model. Market knows that these are appearing at cost model mentioned in the accounting policy. This company is in existence since 20 years, so they know the value of this land is 20 times more than what it is appearing, and company have not revalued it. So therefore such companies command a premium over the book value. So that is not due to goodwill. What about other internally intangible asset? So usually the expenditure incurred on other internally generated intangible asset, those expenditure we will divide into two phases. Example, internally generated intangible asset, software you can develop for your own company. Okay. Or say another example, patent you can develop for your own self, technical know-how. Okay. So they are saying that to divide the expenditure into two phases, research and development. Research phase is the beginning of thinking about an idea and checking whether this idea can be put into practice or not. Okay. So that is research phase. Research phase expenditure will be charged as an expense as and when incurred. Very good. Why? So I have written the reason also. This reason is demonstrated in your standard itself. If you read the bare text, everything is given in detail. Okay. In the research phase of an internal project, the entity cannot demonstrate that an intangible asset exists that will generate probable future economic benefit. That is the reason. During research phase, we are not certain about future economic benefit. Okay. We don't know whether this research will finally get converted into commercial use or not, because one more phase is there after that, development phase. Okay, it takes time to exactly convert an idea into a commercial product. So therefore, future economic benefit criteria which is required for recognizing an intangible asset is missing. Charged to expense. And once it is charged to expense, subsequently it cannot be capitalized even though the idea becomes successful and it goes into commercial production. Once charged to P&L account, charged forever. Writing back of an expenditure charged earlier is not permitted. Okay. Next is development phase. Development phase begins after the research phase is over and before the commercial production start. You are actually now going to see whether this idea can be commercially executed or not. So research phase tells you, yes, this can be done. But whether this can be commercially done or not, you need to do more development. Okay. So what are the criteria? The standard says you can capitalize development phase expenditure as intangible asset, but it should fulfill following conditions. Now following conditions means all are must. It is not one of the 6. All 6 conditions must be fulfilled. If yes, welcome to this standard. And which are these conditions? One is technical feasibility of completing the intangible asset. Whether this intangible asset can be technically completed. Is it technically viable? Okay. So you may think that I will develop a time machine. Good idea. This is an idea. And then you have to implement it, and then you find no, technically it is not feasible to move across the timeline. At least whatever technology we have right now, can we? No, otherwise what you will do? You'll go forward or backward? Forward. What would you like to see? Suppose there is a time machine and you are given one chance to go to future or past. Where would you go? Future. Which year? On your result date you want to see what you will get. Oh, then you'll go to that date when time machine will be invented, and then you will invent it now. You'll learn the process. Oh, wonderful. You, one more person. Okay, you will decide and tell me tomorrow. Next is availability of resources. People have lot of ideas, okay, but there is no money, there is no finance, no technical resource or other resource. You can't capitalize. Okay, so resources means technical resource, like you will require hardware, software and technically qualified people. Finance, the most important resource, and other resource like other management resources. Okay, for example, a business plan showing the technical, financial and other resources needed and the entity's ability to secure those resources. So management has to ensure that we have all the resources. You as an auditor will have to check whether what they are saying is right or not. In some cases, the entity demonstrates the availability of external finance by obtaining a lender's indication of the willingness to fund the plan. And then third is intention to complete and use the intangible asset. So management should demonstrate its intention also. Idea is one thing. Intention to put it to use is another thing. My idea is I will study 16 hours per day and become a rank holder. Next day when I get up, I think no, I need to sleep another half an hour. Okay. And then in the afternoon also, after the lunch, I feel little mentally heavy. Stomach is heavy, we'll sleep for another 2 hours. We'll try this plan from tomorrow, 16 hours. Okay. So intention is not there. Only feasibility is there. And then next is ability to use or sell the intangible asset. Now, ability to use or sell means, this is the same explanation of this point. Probability that intangible asset will generate future economic benefit. Okay. Now, what is the point in creating some asset which cannot be either used by you for cost reduction, revenue generation, or you can sell it to others? The entity will have to demonstrate. Now, some extra line I have written, just in case if you are doing audit of development phase expenditure, check whether the entity can prove that there is a market for the output of intangible asset. That is what you are proposing to sell. Is there a market for that, or are you going to use the asset internally? Okay, the intangible asset will be useful to you. Okay, this you have to prove. Otherwise, there is no future economic benefit. If you can't use it or sell it, then there is no future economic benefit. And the last is very simple. Expenditure should be measured reliably. And for that, the institute says, or the standard says, companies should have a good cost accounting system, good financial accounting system, and they should be able to keep a track of the expenditure incurred like salary, etc. on developing an intangible asset. Okay. So these are the 6 conditions: technical feasibility, availability of resource, intention to complete, ability to use or sell, future economic benefit, and expenditure can be measured reliably. Only if it can be demonstrated that these 6 conditions can be fulfilled or are fulfilled, then you will capitalize the development expenditure. Now the next question is, suppose we have proved that all 6 conditions are fulfilled. Which cost we will capitalize and which cost we will not capitalize? So like a normal, you have learned IAS 16 also in self-constructed asset. use that knowledge. Capitalize all material costs that may be used, services, okay, salaries, wages and other employment related cost. That means those personnel who are working on this project, their salary, wages and all other employment related cost will be added to the cost of this intangible asset. Any other expenditure that is directly attributable to generation of the intangible asset. Like for example, immediately after you develop a software, a design, a process, a system, get it registered as a legal right. Otherwise, some of your employee will immediately leave the organization and sell it to some other party or start his own business. Huh? Mark Zuckerberg, what he did? Idea of Facebook was of his friend. Okay. So that is why I said you get it registered first, immediately. Otherwise, somebody else will take the benefit of that and you can't do much about it. Then amortization of patent and license that are used to generate the intangible asset. Now, what does that mean? If you are using one intangible asset to create another intangible asset, then the amortization cost of that first intangible asset will be added to the cost of the second intangible asset. And then the last is overheads, which are necessary for the generation of the asset and that can be allocated on a reasonable basis. And which cost you must not include at all: selling and administrative expense and other general overheads, which I have written here, unless such overheads are directly attributable to generation of the intangible. So overheads have got some exemption in case if you can prove it that these are directly attributable. Then inefficiencies and initial operating losses incurred before an asset achieves the planned performance. So these are abnormal losses. Don't capitalize it. Charge it to profit and loss. And then they've specifically mentioned this item also: expenditure on staff training. Once the asset is ready, you may give training to the staff, but as you know, staff are not reliable. There is a lack of control test there. After receiving the training, the staff can leave and you will not get the benefit of that. So no control over the staff training. Question for you: state your opinion in the following situation. Note number 6 of the published account of K Limited reads as follows. The company, being a manufacturer of a pollution control equipment, entered into a collaboration agreement with foreign manufacturers for technical know-how comprising the supply of drawing and design and training of personnel for manufacture of different types of pollution control equipment. These arrangements were concluded after the commencement of the production at the beginning of the year. Collaboration amount of rupees 100 lakh is payable in 5 annual installment. Company has amortized the entire cost of technical know-how as a depreciable asset and has shown the same in the schedule of fixed asset. So you should say that out of 100 lakh, the cost towards drawing and design can be capitalized as intangible asset, and the cost towards the training of the personnel will be charged to profit and loss account. So I have written the answer also. As per IAS 38, training costs should not be capitalized. Company should capitalize only the cost relating to design and drawing. Training cost does not satisfy the criteria of intangible asset, that is control, so it cannot be capitalized. Right. The standard says those expenditure which will not form part of cost of intangible asset, okay, which is not related to business combination and does not form part of goodwill, all such expenditure will be charged to profit and loss. No concept of deferred expense now. Either capitalize it under PPE if it fulfills that definition, or intangible asset if it fulfills this definition, or if it is a part of business combination and get recognized as goodwill as a balancing figure. Other than that, charge to profit and loss account. Okay, it should be noted that once written off as an expense, it shall not be recognized as cost of intangible asset later. So once PL, always PL. Okay, no write back. Now, which are the examples they have given in the standard? Example is expenditure on startup activities, that is startup cost, unless this expenditure is included in the cost of an item of PPE in accordance with IAS 16. So if it can be capitalized under IAS 16, then yes, otherwise charge to PL account. Example of startup cost: establishment cost such as legal and secretarial cost incurred in establishing a legal entity. This is what we call in India preliminary expenses. Preliminary expenses charged to profit and loss. Then expenditure to open a new facility or business, that is pre-opening cost, or expenditure for starting new operation or launching new product or new process. These are called pre-operating costs. So pre-opening cost, pre-operating cost, charge to profit and loss. Expenditure, next is expenditure on training, repeated again. Expenditure on advertisement and promotional expenses, including mail order catalogs. What is mail order catalog? That means nowadays this is not used much, but still, suppose you make an advertisement, you have the address of your customer, or you get the address from different sources, you send them a physical copy of the advertisement literature. Sometimes it comes in your post office, your post office box at your home, right? Especially in CA exams, it is flooded with all this advertisement of the candidate. But earlier, when WhatsApp and this Instagram and Facebook was not there, so in your letter box you'll find a lot of advertisement are there. Expenditure on relocating or reorganizing part or all of the entity, P&L account. These examples are given in the standard itself. I have not written. Only startup cost, if it fulfills capitalization under IAS 16, you can. Otherwise, this list is again not exhaustive also. These are examples. Will be recognized in income and will be recognized statement of profit and loss. Now we'll solve one question. First they are saying explain, and then saying in brief as to how you will deal with the following. Explain the following. A company with a turnover of about rupees 100 crore, an annual advertisement budget of 50 lakh, has taken up the marketing of a new product. It is estimated that the company will have a turnover of about rupees 10 crore from the new product. So, future is bright. But the question is whether this advertisement cost will be capitalized as intangible asset. The company has debited to P&L account the total expenditure of 50 lakh incurred on extensive special initial advertisement campaign for the said product. So is the treatment given by the company right? Every time don't write wrong. Sometimes they give you a correct treatment also. So the answer is correct treatment. IAS 38 does not permit the capitalization of expenses incurred on advertisement or brand promotion. Accounting treatment of debiting the entire advertisement expenditure in P&L account is correct. Okay. So now just one more related example. How would you react to the following situation? Rupees 5 lakh paid by pharma company to legal advisor defending the patent of a product created as a capital expenditure. Will the legal expenditure paid once the product is ready, okay, can be capitalized? The standard says that all such expenditure are usually for maintaining your existing asset. They do not create any new benefit, and therefore they should not be treated as capital expenditure. So don't go by the amount of expenditure, go by the nature of the expenditure. And if this nature of expenditure does not fit into the definition of intangible asset, even the subsequent expenditure has to meet the definition of intangible asset. If not, it will be charged to profit and loss. Is it right? Now we will continue tomorrow.